Good morning, Richard Calhoun, real estate broker with Creekside Realty, 40 years of working here in Silicon Valley with buyers and sellers. My information is at the bottom center. We're here to talk about the Silicon Valley real estate market, and we do that looking at graphs. This is week number 4. We will come back to this URL. I will point out the handout was posted about 8:38 this morning. It is 25 pages long. You can print it out at any time. Here's the first data slide. What you're looking at is supply and demand. There's two supplies. The blue line down here is the current total available inventory. This is available inventory that does not have an underlying contract. I do not count those transactions that are pending continue to show. I don't think they're available to the next buyer because the first buyer has to get out of the way first. So I don't count those. Many people do. You can see that we're now at 68% of the 5-year normal, which is the yellow line. The 5-year normal is defined as 2015 through 2019 median. And we're looking at macro data here mostly, which is Santa Clara, San Mateo County, single family condos and townhouses all put together in a blender. We're trying to get an idea of what the market's doing. So you can see we have less inventory than we normally do. Last year at this time, we had 145% of the inventory. So we're basically somewhere around 40% of the inventory we had last year, less than half the inventory that we had last year. That just gives you an idea of how little there is to pick from and what will likely happen with prices. The other supply is the gray line. That's the number of new listings that are coming on the market. And you can see the first week we were below the 5-year median. We've been above for the last 3 weeks now. Most of last year we were at or above the 5-year median. I expect that to continue. I don't expect it to be significantly above. The hope in the industry, I think, was with Prop 19, more people would be selling. There hasn't been any flood of more sellers. Now, maybe once we're past the pandemic and people aren't reluctant, that might happen. What I find interesting is a lot of people say the reason we have so little inventory is because those sellers' reluctancy. It's not the sellers are being reluctant. They're coming on the market at or above the rate they normally do. What we have is the demand side, the red line, that's above. Yes, the first week was below, but that's a calendar event thing. New Year's Day was on Saturday. So my first week for this year, for 2022, was January 1st through January 7th. A lot of years, it's closer to something like January 3rd through January 9th. That gets you further away from the holidays. As we move away from that holidays, that calendar shift becomes less important. And so you can see now that we're having more demand come on the marketplace than normal. And that's what the story is. Look at last year. Basically, most of last year, we were about 15% above the level of demand. So it's the demand, that 15% extra demand is driving the marketplace. Now we look at supply and demand ratio in the terms of days of unsold inventory. This is how long it would take to sell the existing level of inventory at the existing rate of sales. I define the white area here as a balanced marketplace, and I'll share that very rarely is Silicon Valley in a balanced marketplace. We're typically in a seller's marketplace. Occasionally, we're in a buyer's marketplace. Those are the two marketplaces stable. We only seem to be in a balanced marketplace while we're transitioning from a seller's market to a buyer's market. That tends to happen pretty quickly, or coming back down from a buyer's market to a seller's market, which happens a little slower. The pattern here of the days of unsold inventory, which is again the blue line, is very normal. You can see it follows the same shape as the yellow line, because here I'm not doing a percentage, I'm doing raw data so you can actually see. Remember, 2015 through 19 were 5 great years. A low DUI means the market's moving faster. So now we have a market that is much faster than what it was in the median of 5 great years. That's will give you the pace. Last year, we were at 30 days of unsold inventory. This year, we're probably down here somewhere around 14 days of unsold inventory. That's a huge difference. Once you start getting approaching 7, it is very difficult to get below 7 because sellers are going to want to keep their property on the market through a weekend to get exposure. So if you get it ready for Thursday, Friday, have it on the weekend, look at offers Tuesday, Wednesday, you're approaching 7 days, even though it's selling on the first weekend. But the takeaway is DUI remains very strong. There's no indication that the interest rates increase is causing a problem or anything of that nature. Even if it slowed down some, you could get up to 40, and I'd still expect rapid appreciation. I would expect some appreciation, 3 to 5%, all the way up to about 65, 70 days of unsold inventory. That's when you would start seeing stabilization of pricing. And I'm not seeing that anytime. Now what we're doing is looking at a measure of the buyers. How much pressure are the buyers feeling? Each line on here, and the purple line is the most current line, is the sale price to list price distribution for the transactions that have closed in the past week. And I don't get sale price until the property is closed. And so therefore, I have to use closings. That's a little bit of an issue because that creates a 5-week lag time as the typical escrow happens. It also skews data a little bit because some escrows are quick and close in a week. Others are long and take 5 or 6 weeks to close. Some maybe even 7 or 8 weeks. So that skews and dilutes the actual market activity. The red line up here is the best month data that we ever had, which was April 2018. And the dotted blue line down here is the worst month we ever had, which was December of 2001. And that's to give you an idea of what the range is. The 22 weeks in between are all weekly data. The dotted lines are the oldest data, and then the dashed lines are the next oldest, and the solid lines are the most recent. So if you just look at this globally, there is a dashed line down here towards the bottom, but remember, this is week data, weekly data, and sometimes you have a holiday that moves the data up or down. But basically, your dotted lines are at the bottom of the graph, then your dashed lines and your solid lines are up, which is an indication that the market's been moving and improving. In general, I would say the market's been pretty flat. I don't think there's much difference in the range anywhere in there of what we've been talking about. But in general, the purple line up here would be better than this dotted sort of orange-brown line down at the bottom. There is some improvement in the marketplace. There is more fluctuation. Last week, we were lower down. 2 weeks ago, we're almost in the same place. Or 4 weeks ago, we were almost in the same place. What's it telling you? The way you read this graph is above here, people are getting more than their asking price. So right now it's saying something like 67% and probably closer to 70% of the sellers are getting more than their asking price. You can come way over here and it says that 15% of the sellers are getting somewhere around 22% above their asking price. It all depends on what the seller asks for their price, but this is everybody averaged together. Now we're looking at some of the breakdown of the components. The first one is active inventory. What can we learn from that? Well, the only thing we have is inventory. I would consider 95 to 110% of the 5-year median to be, a reasonably strong marketplace. And where are we at? We're at 52% in Santa Clara County single-family homes. That means in Santa Clara County, a single-family home, we only have half the inventory that we normally have based on the 5-year median. The other column over here is last week. So you can see the market, improved a little bit as far as we have more inventory, but not dramatically. And we're still in the same ballpark. And anytime you only have 50% of the inventory that you would expect in a great tight marketplace, that gives you a super heated, super tight market. But if you move right over the county line into San Mateo County, they have it 81%. Now that's still a tight marketplace, but not nearly as tight as Santa Clara County. And then you jump down to condos and townhouses, and Santa Clara County is at 105%. So that's got slightly more than inventory than you'd expect. And it's in that 95 to 110% range, which is why it's in black ink, because I consider that to be a balanced marketplace. Then you move down finally to the Bay cities in San Mateo County, everything from the crest of the mountains down to the bay, and it's at 174%. And I keep saying that I'm going to at some time go back and look at my data. I almost have to believe my base year is off somehow because we've been about 200% of the inventory, despite all the other indications being a strong marketplace. And it's hard for me to fathom that you would have double the inventory you would expect and still a strong marketplace, unless it's just people going over there and being grateful to be getting into real property versus the single family home they really wanted. But that's something I want to research a little bit more, but this is what my current data indicates. Now we move over to offers. With offers, we can pick up the rate of sales. And so now you have the DUI. Now remember, this DUI is based just on 1 week of data. So it's macro data, so it's fairly large sample size, but it gets impacted by the holidays and things of that nature quite a bit. So what's happening, sales volumes picking up. So we've decreased from last week from 22.7, 23 down to 20. That may not sound like a significant improvement, but as I was talking about, as you get a lower and lower number, it is harder and harder to get that number to decrease. 20 is a pretty low number. It's a pretty aggressive marketplace. The biggest reason that you don't put a lot of faith in these numbers is that it is only a 1 week snapshot. But when you start looking at the trends, it becomes pretty clear. In San Mateo County, you went from 22 days down to 20 days. In Santa Clara County, condos and townhouses, 33 to 28. And in the Bay Cities, 24 to 19. So probably the single biggest reason all these numbers improved from last week to this week is we had time to sell some of the properties that have come on the market since the first of the year. There was more inventory to sell. With a higher rate of sales, you decrease your DUI. Then now we go over to closings. With closings, we get the sale price. We do a lot of things with sale price. We look at how frequently is overbidding. 81% of the sellers are getting overbid, 75% in Santa Clara County. Condos and townhouses a little bit lower at 71 and 52%, but still very strong. There's a lag of 5 weeks. And if you go back now, 5 weeks is going to be exactly December 25th. So you're just next week, you're starting to only have New Year's data. So basically in 2 weeks, this is going to become more stable and a better indicator. Also, I'll point out, I made the comment last week and I make it several times during the year. Every holiday negatively impacts real estate because real estate is an optional event. Well, anytime you have a social event that's taking people and distracting people, that also negatively impacts real estate. And just like I said last week with the 49ers in the playoffs, that negatively impacted our sales volume. They won, they're in the playoffs again this weekend. That's going to continue to make it negatively impact real estate. It may change after the Sunday, or they may win and they may be in Super Bowl and we may have a negative impact for 2 more weeks. It's not a huge negative impact, but it is a negative impact. The 2 exceptions that I constantly mention are Mother's Day and Valentine's Day, which both have a slight positive impact on the real estate market, and that's for year after year. And then if you look at the magnitude of overbidding, this is how much are people willing to overbid, and you can see 113% and 111%, and that is the average overbid, not the median. The median runs about 2% lower than the average, and that's a rough number. It's going to change as the median does, and that's because to get the average, you have some people paying 25% over asking price or 50% over asking price. That brings up the average a lot. It doesn't bring up the median much. And the median is more meaningful, but I don't track that deliberately for this particular statistic because anywhere close to a balanced marketplace, there's going to be a fair amount of time when the median is right at 100% and doesn't move off 100% because some homes are above and some homes are below. The average is always going to be fluctuating and you want some sort of an indicator. That's why I've elected to use the average for the magnitude of overbidding. And then appreciation, this is actually pretty shocking in a lot of ways. And we'll talk about this more when we have the breakdown, but this is the appreciation over 2020 prices. I have not converted yet to 2021 pricing. And you can see single family homes are up fairly significantly because then anytime you get a 11% appreciation over a year, it's pretty good. And in fact, the median price in 2020 was the median escrow was more like the first week in August. So this really isn't, this is going from August of 2020 to January of 2022. So it's a little bit more than a year appreciation. But you can see the peak appreciation for the year was way back for Santa Clara County at the end of June of last year, and in San Mateo County in December. That does not mean prices are falling. You got to be real careful, and we'll get into a slide that shows that a little bit later. And what it means is more homes at the lower end price point are selling, which keeps the median price for the county low. And that's why I've always been a micro market person. Anytime you start blending the data, it doesn't make sense for the marketplace. There is no blended property out there. Every property is in its own little microcosm as far as market conditions. This shows it where you have these low numbers and it would almost look like the prices have been depreciating. And then if you go down to the base condos and townhouses, Santa Clara County is only at 3% appreciation and San Mateo County is minus 10. Earlier this year, just at the August of 2021, it was up 16%. So it's gone from positive 16% to negative 10% in a matter of months. And condos and townhouses tend to be more stable. Again, I don't think this is real property values, but instead what's happening within that area, because that's a lot of different areas. Like, for example, if a whole bunch more homes sell, townhouses sell in Redwood City, and that's going to bring down the median versus if those townhouses are selling in Burlingame or San Mateo. With that, we're done with the quick recap. I'll go over the URLs. To join this meeting Saturday live, you type in this URL. The green is my base URL, tinyurl.com/Silicon Valley Real Estate Market Graphs, and then the year, and that gets you the live presentation. The handout, you just put in the letter H, 2022-01-29. That is posted. You can usually get online about 10 minutes before the hour and print it out if you want to look at it printed or anytime, or if you come and you want to look at the data before I get my YouTube posted. The YouTube of the past channels is here. That's the root URL. And then if you want to get to a specific episode, you put in the 8-digit year, month, date code. With that, I will pause for a second and see if anyone has any questions for me. Not seeing any questions, I will continue on. Moving on, what we're now looking at is the micro market data that I was talking about. In the DUI, you can see how you have the different numbers. These are the number of days that it would take to sell the inventory in each one of these different micro market areas. Those lowest areas, the San Mateo County expensive areas, that's Menlo Park, Atherton, Portola Valley, Woodside, followed by Los Altos and Palo Alto at 57 days. A lot of the more affordable areas are down in the low teens. Moderate priced areas are Milpitas, Santa Teresa, Blossom Valley, North Valley at only 10 days. That appears to be the hottest marketplace at the moment. The redder the color, the hotter the marketplace. Oh, so low areas in condos and townhouses are actually faster than the single family homes. And that just shows you how every marketplace is different. So down here in the condos and townhouses, the moderate low areas at 9.3, it's in general a slower marketplace. So that's the absolute fastest micro market we have. All these areas are good. You can see that with the exception of the very expensive areas, there's no areas that are above 40. And don't think that the expensive areas move slower. Normally, those are some of the hotter areas. So we definitely have changes in the marketplace. I think a lot of that is people are saying, I don't have to go into the office every day any longer. I'm not going to pay the premium to live close to work. Plus, work has been moving south and east over the last several decades. And I would almost say that Santa Clara County, San Jose is sort of becoming more the hub of Silicon Valley versus San Mateo County. And the people that value being close to work now are coming more down into Santa Clara County. The frequency of overbidding, Foster City is no longer at 100%, probably has one house that sold for less than the asking price. Cupertino Sunnyvale is still at 100%. The concept is the same. The redder the color, the more frequent the overbidding. You can see most of the areas are in the 80s. And again, the lowest area that I'm seeing is the expensive areas in San Mateo County at 43%. And don't get me wrong, 43% of the sellers getting more than their asking price is still a pretty good marketplace. Although locally, for the history of the Bay Area, I would actually call that a balanced marketplace. I consider 35, 33 to 50 a balanced marketplace. Anything below a third of the sellers getting more than their asking price tends to be a buyer's marketplace. When we were in the slowest marketplace with about 300 days of unsold inventory after 9/11, we were still having about 17% of the sellers getting more than their asking price. And part of that is a pricing strategy that's been adopted here in Silicon Valley. The next column of numbers is magnitude of overbidding. This is how high is the overbidding. And you can see a lot of the areas are somewhere around 110, 118, 110, 112, 115%, sort of the low teen range. The major exception that stands out is Cupertino at basically 25%. So the average overbid in Cupertino Sunnyvale is 25% above the asking price. Again, that's not the median, but that gives you an idea that people are bidding up quite a bit. A lot of it could be Apple. A lot of it could be the good schools. It could be the low demand. You can see they have 14 days of unsold inventory. And then finally, we move over to pricing. And in pricing for the county data, it's not color coded because I can't put that on the map because the whole map would be that color. I've indicated it's the county by putting it in thousands, which is why the K, where all the micro markets are in millions, which is the M. And here, instead of the red being the hotter marketplace, the red is the more expensive marketplace, and the blue are the least expensive marketplaces, and the white, which is Redwood City, is your median for the micro market area. On the condos and townhouses, there's not as many areas. The prices are a lot more condensed. So the white is the most expensive, and then the bluer the color, the lower the median price is. So the median price is what assigns the color. The number to the left is the cheapest 10 percentile in that area. The number to the right is the most expensive 90 percentile in that micro market area. If you look at the condo prices, they're basically at $800,000, 730,000, 800,000, 790,000, 950,000. Very tightly close together, which is why the color, oh, and another one at 750, which is why the colors are all fairly similar. Now we're looking at each of the components. This is the number of new listings that are come on the market in the macro data in the past week. The blue line is the actual data, and the yellow line is the 5-year median. And if you look at this, you can see the number of new listings coming on the market in any given week is basically right where you'd expect it to be. This is the total inventory. You can see last year, the current data, the blue line, was above the 5-year median. This year, we're below. Last year, you'd expect to have about 1,000 homes on the marketplace, and you had 1,500 homes. You had 50% more inventory than you would expect. Now, instead of having 1,000 homes on the market, you only have about 725. So you have 25% less homes than you would expect to have. You can see very quickly last year we got down to the normal number, and then basically starting in week 16, it looks like it's week 17, but to get the vertical separation, I have to add 1 week to 2021. So you take 17 minus 1 and get 16. And so from week 16 on, you can see the actual total available inventory for a buyer to purchase was below where you'd expect it to be. Here we have the number of new offers accepted during the past week, and that's the blue line. You can see the blue line has been consistently above the yellow line. The few exceptions are the nosedives down, and those were holidays. That's because the 5-year median has 2 weeks that are impacted by the holidays, where when you were looking at a single year, you only have 1 data point. So it's a little bit below, but if you averaged it, it would be higher, if that makes any sense. And you can basically see it's the demand exceeding the 5-year median of what you'd expect. Now you're looking at days of unsold inventory, the single biggest indicator. Starting over here on the right-hand side, you can see the rapid increase because of the holidays. And then you can see the rollover, and now we're starting to come down as we're moving past the holidays. You can see that holiday impact every single year, and then you can see the impact of COVID announcement. And these are bad data points that I did not clear up. I cleared up most of them. Now what we're looking at is the geographical map of Silicon Valley and the different micro market areas, the days of unsold inventory in those different micro market areas. And the concept is the redder the color, the faster the marketplace. The saturated red happens at 7 days. I don't think there's anybody at 7 days at this point. Milpitas is the closest at 11 days. This is single family only, so we dropped off the condo, the affordable condos, I think it was in Santa Clara County, that only had 9 days. And then if you hit 42 and a half all the way up to 77 and a half days of unsold inventory, there is no color. Now, this is looking at county-wide data. We have the 3 major components. Red is Santa Clara County single family homes. The gray line is San Mateo County single family homes, and the yellow line is Santa Clara County condos and townhouses. Historically, the frequency of overbidding, San Mateo County would have been outperforming Santa Clara County, and you can see that back here. It did change just before the pandemic was announced. And since the pandemic's been announced, Santa Clara County has been outperforming San Mateo. They've reversed each other. Came up and got close right here a couple different times, but it's clearly outperforming it. And then the yellow line is the condo townhouse market in Santa Clara County only. This is the map of frequency of overbidding. Same concept, the redder the color, the hotter the marketplace is. So Cupertino is saturated red at 100. It goes saturated red at 95. 33 through 50% is no color. 15% is saturated blue. which we have no blue at all. This is the magnitude of overbidding. You start off on the left-hand side in 2022. You can see we're basically at 10% or 11% above asking price, depending on what week we're talking about. Last year, we were quite a bit lower, but then we rapidly came up and got to 8%. It wasn't until the end of 2021 that we started getting up in the 10% overbidding areas. So this is basically pretty high. This is probably record territory. Macro data is data I didn't have long term. I will say that Santa Clara County single family homes got up to 110%. San Mateo got up to 112%. But condos and townhouses tend to be more stable. And this blended data is basically at 111%. So I suspect that this is record high territory. I just don't have the data to verify it. This is the three major components broken down so you can see how it's been impacted over time. Santa Clara County has been going up recently, and the overbidding is now at about 113%. San Mateo County is down at 11% over asking price. The condo townhouse market is much lower at 3% over asking price. But you can see the general trend has been up over the last little bit with some plateaus and some periods of rapid appreciation. This is the map showing the distribution. The redder the color, the more the magnitude of overbidding. I go saturated red at 17%. The only one that I think is saturated is Cupertino. The Bay Cities is close, but you can sort of see the red here in Sunnyvale. Cupertino looks a little redder than San Mateo, but if you go over here, Santa Clara, it looks almost as red, and it's close, but 116%, it's not quite saturated. It's got 1.3% differential, and that is in the coloring. I'm just not visually seeing it. This we looked at earlier, just to refresh your memory. The reason I bring that back up is for this slide, you can see the more recent weeks more clearly. The concept is the same. The dotted lines down here are the oldest, followed by the dash, followed by the solid. So the solid lines are towards the upper end. Even the dash lines, I mean, there really isn't that much change between any of these points. There's maybe a 10% additional over, 10% more. The seller's getting their overprice. So if you went to 15% back here on the dotted lines, it's only 25%. And if you went up to the best week, it's 35%. So that's the kind of the shift that you're talking about. Not huge, but noteworthy. This is the sale price of the different areas. This is the median only for the different areas. It's the three major components. You can see that prices peaked last summer and then they've come back down. Again, this is median data. I don't think it's necessarily reflective of the property value, and I am expecting a slide pretty soon that will show that, but it's most likely a shift to less expensive areas, going from Sunnyvale, going to Campbell, going from Campbell to Milpitas, going from Milpitas to East San Jose, that kind of thing. People are migrating to more affordable areas. They're making up a larger percentage of the transaction. You can see that San Mateo County had a little bit more fluctuation on a percentage basis. If I plotted this on semi-log paper, it might be the same as Santa Clara County. The condo and townhouses at the bottom here do tend to be more stable, and that's what you're showing. Here's the distribution. Again, this is not, red is not hotter, red is more expensive, blue is more affordable. And you got the three prices on there. The middle one is the median, which is what the color is assigned by. The number to the left is the lowest 10 percentile. The number to the right is the highest 10 percentile and the 90 percentile. And this is why the chart I was talking about, and it sort of reflects on what's happening with property values. Here you can see Santa Clara County had a 24% appreciation. Now we're only at 21. That's not a huge difference. Appreciation in South County is at 38%. Yes, it's down a little bit. If you look, I guess the easiest way to look at it, if you look at all the components in Santa Clara County, there's only one, East San Jose, Central San Jose, South San Jose, that is less than that 21.5%, and it's at 18%. Most of these are in the 30 percentile range. There is no way that if you did like in median of the medians, that you would be only at 21%. So what it's meaning is there's been a migration to the 12th, and it's not the 18%. There's a migration to lower priced areas. So South County, East San Jose, moderate low, and away from the Los Altos, Palo Alto, Saratoga, Los Gatos, Cupertino, Sunnyvale, and even Campbell, Willow Glen. So there's a migration where the lower portion of the marketplace is making up a bigger difference, because you can't have these high rates of appreciation and then turn around and say the county has had 21% property value increase. It's even more telling in San Mateo County, because in San Mateo County, the county data is 11% appreciation, but the lowest micro market area is 14%. So how can the county be going up less than any of its components? It's because the shift is away from the expensive areas to the inexpensive areas. Like the expensive areas would be Menlo Park, Atherton, labeled the expensive areas. The inexpensive areas would be the Coast, Half Moon Bay, and Redwood City. So these are the areas that have to be seen, and even the North San Mateo County. These areas have to be seeing a bigger share of the marketplace. I magnified it so it's easier to read. So we're in January. Now we're on January the 29th today. So this data is through midnight on the 28th, where all this other data was taken on February the 5th and was through midnight of February the 4th. So these months historically are defined as January 1st for 35 days. I don't have that luxury in 2022, so I go reverse. I go from last night, midnight, back 35 days and look at the data. So it's sort of forward-looking data. What's significant on here? The thing that I noticed straight off the bat is the median days of what's on the marketplace is 5 days. That is lower by 3 days. That may not sound like a lot, but it's hard to get your median days on the market on a Friday to be at 5. I mean, that's more than half the stuff had to come on the market since last weekend to have the median days on the market. Because if it hit on the market on Monday, it would have a days on the market of 5. So what's happened, what's come on the market in the last week is more than 50% of the total inventory. What's also interesting is it's higher or lower than the median days on the market and what's selling. So what sold last week was on the market for longer than what sold this week. And that's only because the sellers aren't willing to take it. But you can see 7 days, that's a record low. And it's the only number where the days on the market is lower than the days of what sold. You know, like even here in 18, it was 8 versus 9. So it went up 1. Here you're 5 down to 7. So that's just an interesting observation. It's just, I think a lot of it is probably the calendar event and everything, but it's noteworthy that more than half the homes haven't been through a weekend yet. What else do we pick up? Typically it's the highlighted area. So we're up to almost 300 days of 300 inventory. Are we going to get to 450 by next week? I don't think so. You know, it's going to be tight. It's going to come in a little bit low. Anybody's guess, maybe 350. So 100 days low. 100 units low. Moving down to average days on market, this is what sold. So 18, very similar to 17, 7 similar to 8 and 9 from last year, also similar to 9 and 18. Days of unsold inventory at 20. The lowest on there last year was 22, 18 was 23. So that's a record fast marketplace. Number of sales were at 500. You might argue that that's a record low, but what I'd actually say is we don't have any inventory. That number will also go up over the last weeks. The 49ers are also suppressing that number. It will probably pass this number from 2020. It's hard to tell. And then you get down to sales data and you're at 113% versus 108%. 81% of the sellers are getting over asking price versus 73. So you can tell the buyers are feeling a whole lot more pressure. The median price is at 1.665. That did get up to, I think it was 1.704. So this is not the record high for the county. And again, this is Santa Clara County single family on this historical data. This is the last slide. I'm comparing apples and apples, but because of that, I have to go back to January 5th and then compare things. So it's sort of an historical look. And you only had 182 properties on the market, which is the lowest. Your days on market for offers accepted were the lowest. Your DUI was the lowest. Your sales were actually not the lowest, if I'm reading that right, because that looks like 409 just last 2 years ago and 487. So that was 474. So pretty close. And the amount of overbidding is a record 111.3 versus 109.5, 79.5 versus 75. And the median overbid was the highest we had, not for this time of the year. It's not an all-time high because there was a week, and I guess it would probably have been towards the end of June, where we were at 1.704, I believe was the number. And with that, we recapped. I'll pause and see if anyone has any questions. You can join me next week by going to this root URL up here and adding the year 2022. Then the handout is posted. So you add in H 2022-01-29. And with that, I'll pause and see if there's any questions. Not hearing any questions. Have a nice week, everybody. Take care.